Bismillahirrahmanirrahim. Assalamu alaikum. We will continue with our course Investment and Portfolio Management MGT531. Today's lecture is lecture number 32 and the reference book is the same as by Christina in 2010, Investment Analysis and Portfolio Management. The summary of the last lecture is using options as investment, option types, portfolio protection with options, hedging, and summary of the chapter. Today's contents are we will do the question and answers of the last lecture, that is using options and investment, and then we will start next chapter that is about active versus passive portfolio management, strategic versus tactical, asset allocation, monitoring and reviewing of portfolio performance measures, summary, and at the end we will do the question answers and the problems of the and question and answers of questions and problems of the options investment. Chapter number 7 are given here. Question number 1 is distinguish between put and call options. What does it mean to say an option buyer has a right but not an obligation? Third is that explain the following terms as in the money, out of money, at the money. What is the difference between option premium and option price? What is the relationship between option price and their increasing value? Why is the call or put writer's position considerably different from the buyer's position? Seventh is what is an index option? What are the main differences between the index option and stock option? How can put used to protect a particular investor's position? What is the maximum amount of buyer of an option can lose? Question number 10 is that assume you hold a diversified portfolio of common stock. Under what conditions might you want to hedge it using a stock index option? A part. Explain how these options can be used for hedging. What happens with your hedged portfolio if the stock market will fall, and what happens with your hedged portfolio if the stock market will grow? And then we have the next chapter, which is about portfolio management and evaluation. Many contents are active versus passive portfolio management. Second is strategic versus tactical asset allocation. 8.3 monitoring and revision of portfolio. 8.4 is portfolio performance measures, and summary, key terms, and question and problems. We will start from the active versus passive portfolio management. Active versus passive portfolio management. There are two types of investment portfolio management. First is active portfolio, second is passive portfolio management. The main points for the passive portfolio management are holding securities in the portfolio for the relatively long period with small and infrequent changes. Investors act as if the security markets are relatively efficient, and the portfolios they hold may be a surrogate for the market portfolio. Index funds. The passive investors do not try outperforming their designated benchmark. The reason when the investors with passive portfolio management make changes in their portfolio, the investors' performance change, and second, the risk-free rate changes. And the conscious forecast about the risk and return of the benchmark portfolio changes. We have main points for the active portfolio management, and what are those main points? Active investors believe that from time to time there are mispriced securities or groups of securities in the market. Second is the active investors do not act as if they believe that security markets are efficient, and the active investors use deviant predictions. Their forecast of risk and return differ from conscious options. And then we have the comparison of active versus passive portfolio management. We have three columns here. The first column gives us area of comparison, second gives us active investment management, and third column comprises of details of passive investment management. As the first row we have aim, that is to achieve better results than average in the market. This is the active management, active investment management, and for aim the passive investment management is to achieve the area market results. And area of comparison, second is strategies used and decision making, and active management is that short term options positions, the quick and more risky decisions, keeping the hot strategy. And the third column, which is about the investment, the passive investment management, shows that long-term positions, slow decisions. And third, we have investors and managers as the area of comparison. Active investment management is tense and passive investment management is laid back. And area of comparison is taxes and turnover of investment portfolio. Active investment management is high taxes, relatively high turnover of portfolio, and passive investment management is low taxes and small turnover of portfolio. Area of comparison is performance results before cost and taxes, and active investment management is in average equal to the passively managed portfolios, and passive investment management is in average equal to the actively managed portfolio. Area of comparison is performance results after cost and taxes, and active investment management is in average lower than market index after taxes. Passive investment management is in average higher than the results of actively managed portfolio returns after taxes. And then we have area of comparison individual investors, and active investment management is over 85% from total individual investors, and passive investment management is over 15% from total individual investors. And then we have the area of comparison as institutional investors, where active investment management describes over 56% from total institutional investors, and passive investment management is over 44% from total institutional investors. And next area of comparison is porters and active investment management, all brokerage firms, investment funds, hedging funds, specialized investment companies. And whereas passive investment management includes passively managed pension funds and index funds. And then area of comparison comprises of analytical methods, whereas active investment management is qualitative, avoiding risk, forecast, emotions, intuitions, success, speculations, gambling. And as a specific investment management, we have quantitative analysis, which involve risk management, long-term statistical analysis, precise fundamental analysis. These were the important active versus passive portfolio management comparison, where we have a number of different comparisons areas, and then we discussed at the what is the active investment management and how the passive investment management can be done according to these areas. What are the sources of this particular study and particular type of the comparison between the active and passive management? The source is Statistical Data of Treasury Department, 2006. It was the study in the USA. And there are arguments for both active and passive investments, though it is probably a case that a larger percentage of institutional investors invest passively than do individual investors. Then of course the active versus passive investment management decision does not have to be strictly either or choice. One common investment strategy is to invest passively in the market investor considers to be efficient, and actively in the market investors consider inefficient. So what basic comment over here is, and the basic comment over here as far as investment strategy is concerned, that is the actively that is the passively investment shows the investor is efficient and is doing efficient management. However, actively investment in the market indicates inefficient, and we can say that active versus passive investment management decision does not have a strict choice. Investors also combine two by investing part of the portfolio passively and another part actively, and the two part of the management are, one is the active management and second one is passive management. Some active and passive management strategies commonly used for stocks and bonds portfolios were discussed in chapter number 4 and 5. And asset allocation focuses on determining the mixture of asset classes that is most likely to provide a combination of risk and expected return that is optional for the investor, that is about the diversification of the portfolio. So we can say that how the asset allocation focuses on determining mixing of asset classes, and this is particularly with reference to strategic versus tactical asset allocation. And in the asset allocation we have a number of different features. One is combination of the risk and expected return that is optimal for the investor, that the investor should have the optimal decision and should diversify portfolio as far as the combination of and mixing of the risk and expected returns is concerned, so that he or she can maximize and optimize his objective. And asset allocation is a bit different from it. Focuses on investment in various asset classes, that is basically tells us that how the funds should be allocated among different assets. So we can say that it basically concentrate on the different classes in the assets allocation. And then we have the concept of diversification. We have also again we have previously discussed the concept of diversification, that what the diversification is, and in contrast diversification tends to focus more on security selection, selecting the specific securities to be held within an asset class. So what is difference between between asset allocation? Asset allocation focuses on the investment in various active classes, asset classes, and diversification, it focuses selecting the specific securities to be held within an particular asset class. And asset classes here is understood as group of securities with similar characteristics and properties for further common stock, bonds, and derivatives. Then we can say that here they are basically indicate the group of and the particular classification or category of the securities which have similar characteristics and which adopt similar features. For example, they can be known as common stocks, bonds, and derivative. All these have similar type of features, and they belong to one group. For example, common stocks, they belong to one group, bonds one to another group, and the derivatives, they belong to another third group. And therefore asset allocation precedes other approaches to investment portfolio management, such as market timing, buy low and sell high. So asset allocation proceeds has important feature which is about the timing of the specific to timing of the investments, timing of the trade in the market. That is the investor should invest at the time when the prices are at low level and should try to sell at the time when the prices are at high level. Then selecting the individual securities which are expected will be winner, and we can say that there can be two type of the securities or the assets under which the individual can take the trade. For example, when he say that the prices are going low and this is the best time as far as the timing of the trade is concerned to purchase the assets, and we can say the assets he is already having in his portfolio, if the prices is falling, we can say they are the losing stocks and they are losing assets. So it will not be a good decision to sell those assets. Rather, it will be better for the individual investor or institutional investor to purchase the assets whose prices are at low level or whose prices are showing a desperate situation in the market. However, the investor will find better profit position and better economic position if we select the assets whose prices are going up or are showing a peak position in the market to sell. That is, they will be known as the winner assets, and they will be known as winning stocks and securities. Therefore, it is better decision for the investor to purchase the losing stock and the securities, and to sell the winning stock and securities in order to get maximum benefit, in order to optimize his behavior of investment, which is associated with the minimum cost and with minimum risk. And these activities may be integrated in the asset allocation process, and but the main focus of the asset allocation is to find such combination of the different asset classes in the investment portfolio with the best matches with the investor's goal, the expected return on investment, and the investment risk. We can say what is the important or efficient goal setting or aim setting is that to have the better combination or best combination of the risk and the returns, where the risk will be at high level and the risk will be at low level and return will be at high level. So we can say this is the best match between the risk and return to achieve the goal by the investor. And continuing with the discussion about the asset allocation, we can say that asset allocation largely determines an investor's success or lack thereof. In fact, studies have shown that as much as 90% or more of portfolio return comes from asset allocation. Further, more researchers have found that asset allocation has a much greater impact on reducing total risk than thus selecting the best investment vehicle in any single asset category. And two categories in asset allocation are defined. The first is strategic asset allocation and second is tactical asset allocation. Strategic asset allocation identifies asset classes and the properties for those asset classes that would comprise the normal asset allocation. Then strategic asset allocation is used to derive long-term asset allocation weights. And the fixed weighting approach in strategic asset allocation is used. We can say that strategic asset allocation basically focuses on asset classes and focuses on the proportion of asset classes that would comprise normal asset allocation. They would follow normal track for the allocation of the asset, and this is also known as strategic asset allocation. They are for use for the long term, and the fixed weight approach is also used in the strategic asset allocation. Investor uses this approach, allocates a fixed percentage of the portfolio to each of the asset classes, which typically are here the 3 to 5. And what are they? The example of the asset allocation classes in the portfolio might be as follows. And they are here we have the column about the asset classes. We have two columns. In first column we give the name of the class, and second column we give the example of their weightage. First asset class is common stock, and 40% is allocated to common stock. And second example is of the bonds. Second asset class is of bonds. 50% is allocated to the bonds, and then we have the short-term securities, and 10% of the portfolio allocation is towards the short-term securities, and the overall portfolio comprises of 100% the bond stocks and securities. And generally these weights are not changed over time. When market value changes, the investors may have to adjust the portfolio annually. So we can say that they do not change frequently, however they may change annually after major market moves to maintain the desired fixed percentage allocation. Then tactical asset allocation produces temporary asset allocation weights that occur in response to temporary changes in capital market conditions. The investor's goals and risk return preferences are assumed to remain unchanged, as the asset weights are occasionally revised to help attain the investor's constant goals. For example, if the investors believe some sector of the market is over or undervaluated. And then the passive asset allocation will not have any changes in weight of the asset classes in the investor's portfolio. We can say as far as the passive asset allocation classes are concerned, there will be no change observed in the allocation of the portfolio items, and the weight is allocated to different choices of the portfolio. The weights identified by the strategic allocation are used, and alternatively asset allocations are often related with the different approaches to risk and return. However, allocation classes, they are for the assets, they are allocated to the approaches of the risk and return, and the element of risk and return should be kept into account. They should be considered while the allocation of the assets. Identify conservative, moderate and aggressive asset allocation. So we can say as far as the strategic allocation is concerned, weights are used for the passive asset allocation, and alternatively asset allocation, they take into account, they focus on the elements of the risk and return, and there are three different types in this concern. One are the conservative type of the allocation, second moderate, and the third indicates the aggressive type of asset allocation. Now, continuing with the discussion, what is the conservative type of allocation of the assets? This focus on providing low returns with the low risk. What is conservative? That is, we can say that investor is highly risk averse and is highly careful about the allocation of the assets in his portfolio, because he's careful because he wants to avoid the rate of risk and wants to maximize the level of return. And then we have the second type of the asset allocation, which is the moderate type of asset allocation. They concentrate, these investors concentrate on average return with the averages, that the moderate level of risk is associated with the moderate level of of returns, and this is specific for the investors who are having who prefer to have the moderate type of the asset allocation. Then we have the third type, which is the aggressive type of asset allocation, which is associated with the high return and the high risk. The example of the asset allocation is presented in the table. I will for asset allocation decision, Markowitz portfolio as a selection technique can be used. Although Markowitz model that we discussed in the chapter number 3 in detail was developed for selecting portfolio of individual securities, but thinking in terms of asset allocation, this model can be applied successfully to find optimal allocation of the assets in the portfolio. The program exists to calculate efficient frontiers using asset classes, and Markowitz model is frequently used for the asset allocation in institutional investor portfolio. We can say that although in chapter number 3 this particular model focused on the individual investors, but as far as the asset allocation is concerned, Markowitz model can be used to elaborate the concept. The correlation between asset classes is obviously a key factor in building a optimal portfolio, and with the help of the correlation between different classes of the assets allocation, we can formulate optimal portfolio assets. And investors are looking to have in their portfolio asset classes that are negatively correlated with each other. That is, they have negative relationship with each other. If we invest in one type of the portfolio item, or we can say that if we allocate in one type of the portfolio item, then we will have the reduction in the other type of the portfolio. So there is a negative relationship, or at least not highly positively related with each other. This was discussed in the chapter number 2. It is obvious that correlation coefficient between asset classes returns change over time. It is also important to note that historical correlation between different asset classes will vary depending upon time period chosen, and the frequency of the data and the asset classes used to estimate the correlation. Using not only historical but future correlation coefficients between assets could influence the results remarkably, and because the historical data may be different from the expectations, we can say in order to look at the correlation between the assets, we have to find the historical data, that what have been the trend between the correlation of the assets over the past time period. And in a similar way, we can observe that what the individual should do and should take the decision as far as the correlation of the assets is concerned, because we can say that some assets, they are negatively correlated with each other as far as their returns are concerned. At one hand, if the returns of the one asset is going to increase, and if we hold the second asset, for example asset B, so it is quite possible the returns are likely to decrease. And we find that if they are having negative relationship, so it is best for the individual, if the individual keep these two types of the items in his portfolio, so we can say that if the returns from one they increases, so individual can find those assets as a winning assets and can sell them in order to earn the benefit out of them. And those who are losing assets, the individual can decide to keep them with themselves, and the investors can sell them at the time when the appropriate situation arises in the market as far as losing assets were concerned. Therefore, we can say if we are having the two type of the resources having negative inverse relationship, it is good for the investor to keep those. And here in particular with respect to this type asset allocation, we are finding that the correlation of the asset allocation is important, and we are giving the different weight to the different types of the allocation of the assets. Then we have portfolio revision, and that is monitoring and of the portfolio, and revision of the portfolio. That is, if we once we have settled down our portfolio, we have decided our portfolio, and based on the risk and return associated with different items kept in our portfolio, we can monitor the performance of the portfolio, and we can revise the portfolio whenever needed. As in the previous lectures, we discussed that if we find that one portfolio is not giving us better, a portfolio item is not giving us better result or better outcome, or we can say that if we are not able to get benefit out of it, so we can postpone, or we can we can exchange it and transfer it from one type of holding to the other type of holding, or we can exchange between these different assets holding. So therefore, in order to optimize our behavior, these type of decisions can be taken. And portfolio revision is the process of selling certain issues in portfolio and purchasing new ones to purchase them. So we can say when we can revise the portfolio only when monitor the performance. When we have decided the items of the portfolio, and then afterwards we monitor the performance of the portfolio, we find that some item is not performing better and is not likely to give us more benefit and profit. So we can decide to revise our portfolio. So we can say that it is the process of revision is the process of selling some issues in portfolio and some items in portfolio, and instead we can purchase some other new items in our portfolio by replacing the existing ones. The main reason for necessity of the investment portfolio revision is that as the economy evolves, certain industries and companies become either less or more attractive as investment. So what is the basic logic behind whenever we want to exchange or transfer our portfolio items and issues? The logic behind is that they are not performing well. They are not showing a good result, good outcome, good benefit out of them. So and the reason is that the company which is issuing them is not performing better, or the industry which is providing them is not showing attractive or good results. So we can say we can exchange them or we can transfer them. So over the time, investors may change his or her investment objectives. In this way, his portfolio is not longer optimal. We can say that investors they can revise their decision about the items or the portfolio. They can quit with the existing one. They can purchase the new one, and we can say in this way they can change their objectives to optimize their goal of maximizing the benefit and with the minimum level of cost, with the minimum level of risk associated, and the constant need for diversification of the portfolio. Therefore, we can say that there is, if this happens, that individual they can revise their portfolio and they can quit with the existing one. They can purchase the new items. So this is known as that we can diversify our portfolio, and we can have the constant need for the diversification. And always we should concentrate as an investor, as a rational investor, to diversification of the items and issues present in our portfolio in order to extract maximum returns and benefit with the minimum cost and minimum risk associated. Therefore, we can say that individual securities in the portfolio often change in risk and return characteristics, and their diversification the effect may be lessened. So, what is the logic as far as the securities are concerned? And we have kept them and we have purchased them in our portfolio, and their risk and return association and characteristics frequently change, and therefore their diversification effect may be lessened. और उनका diversification effect जो है वो उसकी वजह से कम हो जाता है, क्योंकि उनका risk and return जो association है वो frequently change होती है और fluctuate करती है. 3 areas to monitor when implementing investor portfolio monitoring is that first area is change in market conditions, and why the individual basically tries to or decides to change his portfolio, why the individual decides to revise his portfolio or diversify his portfolio, or in simple words we can say when he feels the need to reset his goals, which are the optimizing goals. The first important logic behind these changes in the decision of the investor is that there may be changes in the market conditions. That is, when the market conditions change, when there are fluctuations, when some assets they are showing downfall in their returns and the others are indicating up return in their returns. So we can say market conditions are changing, and they can change their or revise their portfolio. And sometimes also happen that the assets which were showing the good results and they were showing the prosperity, indicating the positive upturn, the results they may show negative and downfall, negative turn and the downfall and their returns. The reason may be there may emerge the economic fluctuations in the economic environment of the country, and there may be political factors which may emerge in the country, and they are likely to affect the trade and the trade environment prevailing in the market. The second important area under which which is basically lying towards the fluctuation and revision of the portfolio of the investor belong to changes in investor circumstances, that when the investor's own circumstances changes, जब उसके अपने circumstances change होते हैं. For example, when investor is not having any more funds to and any more resources to finance his budget, to finance his expenditures as far as the purchase of the different portfolio items is concerned, and when he feel there may be two type of situations. One is that individual is having downfall in his finances or in his economic status. So what he does, he revises his portfolio, and when he needs money in order to undertake the transactions daily in the life or in the business, he may sell some securities and assets, and therefore he can revise his portfolio in this respect. Secondly, we can say if the investor find a positive turn in his finances, or is likely to have strong financial status, he want to expand his portfolio set and want to expand his investment, it is quite possible that he may revise his portfolio set and items to be purchased in portfolio. He may purchase some new one and may sell some existing one, and can extend the choice and extend the level of the portfolio. In this way, he will definitely may increase the number of assets and number of securities which are being purchased. So that this will enhance his portfolio set and his purchases in his portfolio. Third is that asset mix in the portfolio. The need to monitor changes in the market is obvious. The investment decisions are made in a dynamic investment environment where changes occur permanently. The key macroeconomic indicators such as GDP growth, inflation rate and interest rate others, as well as the new information about the industries and companies, should be observed by the investor on the regular basis, because these changes can influence the returns and risk of the investment in the portfolio. So what we can say that macroeconomic indicators, they influence the financial market rate and environment prevailing in the financial market, and they are macroeconomic variables. There may bring changes in the economy, they bring changes in the industrial environment and in the company, and the changes can influence the return and risk of the investment in the portfolio, and consequently we can say that the investor choices they may be affected as a result, because the risk and return level of return they may fluctuate with respect to their assets. And because these changes can affect the level of the risk and level of the returns, the investments are given to their investors for the items being kept and being purchased in the portfolio. Therefore, we can say that there may be fluctuations and in the portfolio, and investors, they can decide to revise their portfolios. And investors can monitor these changes using various sources of information, especially specialized websites more frequently used are presented in the relevant websites. So information is very much important in this respect. Even if the macroeconomic indicators, they are showing the changes in their trends and the political environment is changes, but it is important, and they are having their impact on the economic environment in the industry, in the companies, in the financial market. But it is important that the investor should have the proper information of all these fluctuations, should have proper information of all these changes. And what happens that when there are fluctuations in the trade environment, if the investor has proper information about these changes, he may revise his portfolio accordingly. He may sell those assets which are profit giving and which are known as winner assets, and may keep the losing asset with his portfolio in order to wait for some reasonable time to assess whether these changes should negatively influence the investor's currently held portfolio or should positively affect the current portfolio of the investor. If it is so, investor must take action to rebalance his or her portfolio. So we can say adjustment can take place as a result of the proper proper information required by the investor, and these adjustment in the portfolio means that he is deciding to revise his portfolio, and he's deciding to revise his portfolio according to the situation and for the items which are likely to give him much more benefit and much more return, and are likely to reduce the level of risk. And when monitoring the changes in the investor's circumstances, the following aspects must be taken into account. That is, when the investors want to decide, want to revise his portfolio, want to either extend or contract his portfolio, and he must taken into account these following aspects and following variables. For example, change in level of wealth, change in time horizon, change in liquidity requirements, change in tax circumstances, change in legal consideration, change in other circumstances and investors' need. All should be taken into account while he is deciding to revise his portfolio, or he is deciding to revise the items present in his portfolio. Okay, what is the level of the wealth? How much is the change in the level of wealth, and wealth, whether in positive direction or negative direction? What is the change in the time horizon? Whether time is likely to improve and devolve the situation, or is likely to deprove the situation and desperate the situation. Third is the liquidity requirements should be taken into account depending upon the level of the liquidity requirement he can take. He can revise his decision about the items, about the instruments being kept, and nature of instruments being purchased in the portfolio. And change in tax circumstances, that whether the tax circumstances are changed or not, whether the tax is likely to increase further or is likely to decrease, so what will be the impact on his investment out of the tax. And changes in legal considerations, what are the changes in the legal environment, and changes in other surrounding circumstances, and the investor's need, what is his need at the household level, what is his business need, and investor must take into account all these changes, all these problems when he wants to revise his and monitor his portfolio. And any change identified must be assessed very carefully. That is, and further we can say that investor should have the proper guideline out of these changes, and he should revise his portfolio very carefully. That is, while even with the revising, he should not do so that he is quitting and selling those assets which are losing, and he is keeping those assets which are winning right now. Therefore, careful attention is important to while he is doing the revision of the portfolio. They generally are related with the noticeable changes the investors in investor's portfolio. Rebalancing a portfolio is the process of periodically adjusting it to maintain certain original conditions, and rebalancing reduces the risk of losses. In general, a rebalanced portfolio is less volatile than one that is not balanced. And several methods of the rebalancing portfolio are used here. First important method in order to rebalance, in order to readjust the portfolio, or we can say revising the portfolio after monitoring it, is a constant proportion portfolio. And second is constant beta portfolio. Third is indexing. What is constant proportion portfolio? A constant proportion portfolio is one in which adjustments are made. And that is, we can adjust this type of portfolio, and we can make adjustment and revisions, and we can rebalance this type of portfolio and items we are keeping in this portfolio, so as to maintain the relative weighting of the portfolio components as their price change. So we can say, if we do this, we can basically reallocate the weights we have assigned to the different types of the items in our portfolio with respect to the changes prevailing in the economic environment or in the financial market. Investors should concentrate on keeping their chosen assets allocation percentage, especially those following the requirements for strategic asset allocation. There is no one correct formula for when to rebalance. And one rule may be to rebalance portfolio when asset allocation vary by 10% or more. That is, when we say that there is allocation of assets by the 10% or more than 10%, we can reallocate the items in our asset portfolio. And they should we can say that they should concentrate or focus on keeping their assets allocation percentage, that in what percentage, in what way they are likely to keep certain assets in the portfolio, and in what weight and percentage they are likely to keep certain other assets in their portfolio. This rebalancing is important, even though there is no particular method to revise in this respect the items of the portfolio or percentages of the portfolio. However, the assessment is that rebalance can be done when we see that allocation of the assets changes by 10% in one asset or by more than 10%. But many investors find it strange that constant proportional rebalancing requires the purchase of the securities that have performed poorly and the sale of those that have performed the best. And this is very difficult to do for the investors psychologically. See chapter number 6, that psychological aspect and psychological emotions and effects are also important in this respect. That sometimes we say that the sale of the assets which have performed poor, that is better. And this is so because we overassess the situation, we become overconfident out of the outcomes, and we say that everything will be better, and what the indicators are indicating for the returns of the asset is not in reality, but in reality the assets are performing better. And psychological effect, they may go in two directions. In one direction, we become overconfident in about our knowledge, about our decisions of the choices of the portfolio items, about our level of information we have about the environment prevailing in the market. And secondly, we can say that when we are desperate and we are having bad mood as far as our investment are concerned, as far as the environment prevailing in the market is concerned, and as well as the level of information is concerned. Therefore, investors should consider this method of rebalancing as one choice, but not necessarily the best one. We can say that psychological effect, they should be taken into account, but they should not be we think as all and having all strength while we try to decide our portfolio. And a constant beta portfolio is another type, and the base for the rebalancing portfolio using constant beta portfolio is alternative method to target the beta portfolio. And over the time, the value of portfolio components and their betas will change, and this can cause the portfolio beta to shift, because as we know from the name of the portfolio, it is about the beta portfolio, and we have done the discussion about the value of the beta and about the significance of the beta in any discussion, and we can say it is basically the determining the level of the outcomes, level of the earnings or profit we can have, and it is the sort of slope of the model or equation we have decided in our portfolio, or it is basically a rate of change of the overall returns or overall benefit with holding a portfolio with respect to the change in any particular asset with which beta is associated. And if there are shifts in the value of the beta, so we can say there may be shift in the value of the and in the items of the asset portfolio. For example, if the target portfolio beta is 1.10, so we can say if it has risen over the mentioned period of the time to 1.25, so portfolio beta could be brought back to the target 1.10 in the following ways. Put additional money in the stock market and hold cash, and that is, we should increase the level of the cash, and diluting the stock in the portfolio with the cash will reduce the portfolio beta because cash has beta of 0. And but in this case cash should be only on temporary component in the portfolio rather than on long term. And continuing with the topic of monitoring and revision of the portfolio, we find that put additional money into the stock portfolio and buy stocks with the beta and lower than the target beta figure. If the figure is less than the target beta, but the investor may be not able to invest additional money, and this way for rebalancing the portfolio can be complicated. So this situation may be difficult for rebalance and to readjust the portfolio when we see that the target the individual buy low, then the target our investor buy low, then the target value of the beta. and then sell high beta stocks in portfolio and hold cash. As with the first alternative, this may reduce the equity holding in the investor's portfolio, which may not be appropriate. Sell high beta stocks and buy low beta stocks. This is another important way with the help of which the portfolio can be revised, or we can readjust and rebalance our beta. That is, the high beta stock should be sold and the low beta stock should be bought. And this is the usual attitude of the investor, usual behavior of the investor that they have been doing. They have been, when they have been dealing with the market, stock market or financial market, and the trade in the financial market is concerned with the fluctuation in the prices of the assets, with the fluctuation in the prices of the securities and items. For example, we assume that when the prices are losing, they should buy the assets and keep if he is having the portfolio items in his portfolio which are losing the prices, so he should keep the losing item with himself, and he should sell the winning item at the time when the prices are going high. And a similar case can be associated with the revision of the portfolio over here, that and particularly with the case of the beta model, that is, the individual should sell high beta stocks and should try to buy the losing beta stock, and keeping the existing beta in his portfolio in order to wait for a proper time period. The stocks bought could be new additions to the portfolio, or the investor could add to the existing portfolio. So what we do, that if we buy the stock, we can say that it will be the extension of the existing portfolio, or it could be the addition in the items in the instruments of the existing portfolio. Rather, if he decides to sell the beta stock, we can say this will be the contraction of the existing beta stock in the portfolio, or we can say he is basically reducing the size of the beta stock in his portfolio. And then we have the third type, which is about the indexing. Indexing, this alternative for rebalancing the portfolio, are more frequently used by institutional investors and often mutual fund. So indexing basically is more relevant, more associated with the mutual funds, when individuals are where they have formed institution and they are investing in the form of the institution, or an institution, there are number of shareholders, because their portfolios tend to be larger, and the strategies of matching a market index are the best applicable for them. And managing index-based portfolio, investors or portfolio managers eliminate concerns about outperforming the market, because by designing it seeks to behave just like the market averages. And investors attempt to maintain some predetermined characteristics of the portfolio, such as beta of 1 and 0.0. The extent to which such a portfolio deviates from its intended behavior called tracking error. This is a sort of the tracking error when we have a beta stock in the portfolio and the portfolio deviates from its intended attitude, intended behavior. Revising a portfolio is not without cost for an individual investor. We can say, if in this context, in this scenario, if the individual decides to revise his portfolio, definitely it will involve cost. If the individual is particularly an investor and he is individual and single investor, so in this case time cost will be involved and transaction monetary cost will be involved over here, and this cost can be direct cost, trading fee and commission for the brokers who can trade securities on the exchange. So we can say we have the two types of the cost. One is the direct and second is the indirect cost. And the indirect cost can be when he definitely he has to change his mindset in order to revise the portfolio, and direct cost involve the monetary cost for in the terms of commission and fee for the brokers, and in terms of the time involved. And with the development of the alternative trading system, which is known as ATS, these costs can be decreased. If we develop an alternative trading system, and the level of this cost can go down. It is important that the selling the securities may have income tax implications, and we differ from country to country. And portfolio performance measures are basically involve the determining periodically that we can evolve the performance evaluation measures with the help of determining the evaluation periodically, and from period to period how the portfolio performed in terms of not only the returns earned but also in terms of the risk experienced by the investor. And for portfolio evaluation, appropriate measure of return and risk as well as relevant standards and our benchmark are needed. Therefore, we can say we can evaluate any portfolio or items being kept in any portfolio if we are able to evaluate the level of the risk associated, level of the return associated. These are the characteristics on the basis of which we can evaluate any portfolio items, and we can revise accordingly. And as far as the level of return and evaluation is concerned, we can say that we can guess the changes in the return of the portfolio items from the expected rate of return, and as far as the risk is concerned, we can evaluate with the help of the measurement of the level of risk, which can be done with the help of the standard deviation. In general, the market value of the portfolio at a point of the time is determined by adding the market value of all the securities held at a particular time. So what happens if we want to find out the overall market value of the portfolio at any time of trade? So we have to aggregate the value of all the items. We have to sum up the value of all the instruments and the stocks which are present in our portfolio holdings, so that we can calculate the total value of the portfolio, and we can take our decision accordingly. The market value of portfolio at the end of the period is calculated in the same way, only using end of the period prices of the securities held in the portfolio. And the return on the portfolio is known as RP, where RP is equal to WE minus WB over WB. We can say this is the ratio of the difference between WE and WB to the WB. Here WE is beginning value of the portfolio and WB is ending value of the portfolio. So what we can say this is basically difference between the value of the at the time of the purchase of the portfolio items and value at the time of value of the portfolio at the selling time of the portfolio, and we take the ratio of this difference to the value of the portfolio at the time of the buying and beginning time. And the essential idea behind performing evaluation is to compare the returns which were obtained on portfolio with the results that could be obtained if more appropriate alternative portfolios and have been chosen for the investment purpose. Such comparison portfolios are also referred to as benchmark portfolio. These are known as benchmark portfolio as well. In selecting them, investors should be certain that they are relevant, feasible and known in advance. That is, we can say that these are the target or benchmark portfolio are those that when the individual is deciding to invest in them and is deciding to purchase in them, he must take into account different characteristics, that the items in the portfolio, they are relevant, they are feasible, they are known in advance, they are likely to give more profit and returns. Therefore, if we say that the portfolio item is relevant and feasible, the overall portfolio and the value of overall portfolio will be relevant, feasible and known in advance. The benchmark should reflect the objectives of the investor, and portfolio beta that we did in chapter number 3 can be used as an indication of the amount of market risk that the portfolio had during the time interval. It can be compared directly with the beta of the other portfolios as well. And we cannot compare the ex post or the expected return of the two portfolios without adjusting for the risk. This is an important aspect of this comparison of the returns and risk of the portfolio to decide the portfolio. To adjust the risk for the return for the risk before comparison of performance risk, adjusted measure of performance can be used. And what are these adjusted measures? They are Sharpe ratio, they are Trainer ratio, they are Jensen alpha. And it is important to note that if a portfolio is completely and diversified, all of these measures, Sharpe and Trainer and ratios and the Jensen ratios will agree on the ranking of the portfolio. The reason for this is that with the complete diversification, total variance is equal to systematic variance. When portfolios are not completely diversified, the Trainers and Jensen measures can rank relatively undiversified portfolio much higher than the Sharpe measure does. And since the Sharpe ratio uses total risk, both systematic and unsystematic components are included. And then we will present the summary of the chapter. At the end of the chapter, the main points of the passive portfolio management, who are the holding securities in the portfolio for the relatively long period with small and infrequent changes. Investors act as if the security markets are relatively efficient. Passive investors do not try outperforming their design benchmark. And second point is that the main points for the attractive portfolio management. Active investors believe that there are mispriced securities or groups of the securities in the market. The active investors do not act as if they believe that the securities markets are efficient. The active investors are deviant predictions, and they forecast return and risk differ from census options. And third is strategic asset allocation, identifies asset classes and proportions for those classes, and that would comprise the normal asset allocation, and the strategic asset allocation is used to derive long-term asset allocation weights. The fixed weighting approach is strategic asset allocation is used. The fourth point is that tactical asset allocation produces temporary asset allocation weights that occur in response to temporary changes in capital market conditions. The investor's goal and risk return performance are assumed to remain unchanged as the asset weights are occasionally revised to help attain the investor's constant goal for asset allocation decisions. Marquez portfolio model as a selection technique can be used thinking in terms of asset classes. This model can be applied successfully to find the optimal allocation of assets in the portfolio. And seventh important point is three areas to monitor when implementing investors portfolio monitoring. First is changes in market conditions, second is changes in investor circumstances, third is assets mix in the portfolio, and eighth is when monitoring the changes in the investors circumstances, following aspects must be taken into account. The first is that change in wealth, change in time horizon, change in liquidity requirements, change in tax circumstances, change in legal conditions, and change in other circumstances and investors' need. And the next point is that rebalancing portfolio is the progress of the periodically adjusted it to maintain certain original conditions. Rebalancing reduces the risk of the losses. In general, a rebalanced portfolio is less volatile than one that is not rebalanced. And tenth is that a constant proportion portfolio is one of the portfolio rebalancing methods in which adjustments are made so as to maintain the relative weight of the portfolio component as their prices change. And third, and then investors should concentrate on keeping their chosen asset allocation percentages, especially those following the requirement for strategic asset allocation. And 11th point is that the basis for rebalancing portfolio using constant beta portfolio alternative is the target portfolio beta. Over time, the values of the portfolio components and their betas might not change. This can cause the portfolio beta to shift, and then the portfolio beta should be brought back to the target. 12 is using indexing method for rebalancing the portfolio. The investor match a market index best applicable for them. Managing index-based portfolio investor or portfolio manager eliminate concern about outperforming the market because by designing it seeks to behave just like the market averages. And 13th is that portfolio performing evaluation involves determining periodically how the portfolio performed in terms of not only the returns earned but also risk experienced by the investors. For portfolio evaluation, appropriate measure of return and risk as well as risk standards or benchmark are needed in selecting and a benchmark portfolio. Investors should be certain that they are relevant, feasible and known in advance. The benchmark should reflect the objectives of the investor. The 14th is that to adjust the return for risk and before comparison of performing risk adjusted measure of the performing can be used, and a Sharpe ratio shows an excess return over risk-free rate or risk premium by unit of total risk measured by the standard deviation. The trainer ratio show an excess equal actual return over risk-free rate or risk premium by unit of systematic risk measured by beta. Jensen alpha shows excess actual return over required return, and excess of actual risk premium over required risk premium. This measure of portfolio manager performance is based on CAMP. Then we will discuss the question and problems of the chapter. First question is that give the arguments for active portfolio management. Second is what are the reasons which cause investors managing their portfolio passively to make changes their portfolio. Third is what are the major differences between active and passive portfolio management. Fourth is explain the role of revision in the process of managing a portfolio. And discussion strategic and tactical distinguish strategic and tactical asset allocation. 6 is what role does current market information play in managing investment portfolio. 7 is why is the asset allocation decision the most important decision made by the investor. 8 is what is the important point of investment portfolio rebalancing. And 9 is what changes in investors circumstances use the rebalancing of the investment portfolio, explain why. 10th is why is the portfolio review not free of cost. 11th is why benchmark portfolio are important in investment portfolio management. 12th is briefly describe each of the portfolio performance measures and explain how they are used. And they are Sharpe ratio, Trainer ratio and Jensen's alpha. And next question is 13. Assume that you can plan to construct a portfolio aimed at achieving your stated objectives. The portfolio can be constructed by allocating your money to the following asset classes: common stock, bonds, and the short-term securities. First question is identify, state, and commence your instrument objectives. Second is determine an asset allocation to these three classes of assets considering your stated investment objectives, and explain your decision. And what reasons could cause you to make changes in your asset allocation. At the end of the chapter we have some abbreviations. And first column of the table we have abbreviation or symbol, and second we have explanation. First abbreviation is basically intercept, the point where the characteristic line of the security J passes through the vertical axis. ABS is asset based securities. APT is arbitrage pricing theory. ATS is alternative trading system. Beta J is beta of security J, the measure of the systematic risk. Beta P is the beta of the portfolio. And next table, CF indicates cash flow. CML capital market line. Covariance between RA and RB is covariance between returns of asset A and asset B. CY is current yield. CT is coupon payment in time period T. D is dividend. DL stands for long term debt. DC stands for depreciation. DDM for dividend discounted model. DR for duration, Macaulay duration. And EBIT is earning before interest and taxes. This was the end of the 2 days lecture, and at the end we will discuss the summary points. And first of all we will do that what the basic points of the 2 days lectures are, and what are the contents of the 2 days lecture. It is about the active versus passive portfolio management. That what is the active portfolio, what is the passive portfolio. We have a portfolio passive main points of the passive portfolio management, that is holding securities in the portfolio for a relatively long time period with small and infrequent changes, and they are also known as the index funds. And then we have main points for the active portfolio management. Active investors believe that from time to time there are mispriced securities or groups of the securities in the market, and the active investors do not act as if they believe that security markets are efficient, and they use deviant predictions. Their forecast of the risk and return differ from the consensus applications. Then we have the comparison of the active and passive portfolio management with the help of table, and there we did different areas of the comparison to undertake the comparison. And then we did that the asset allocation focus on the determining the mixture of asset classes that is most likely to provide the combination of risk and expected return that is optimal for the investor. That is, the investor should have diversified portfolio, and it focuses on investment in various asset classes, and whereas diversification tends to focus on security selection, selecting the items or security to be held in within one asset class. Asset class here is understood as group of securities with similar characteristics and properties. And asset allocation proceeds other approaches to invest portfolio management, such as market timing and selecting the individual securities which are expected to give a high result are the sort of winners. And these securities may integrate in the asset allocation process. Time allocation largely determines the investor's successes or the lack thereof. We can say the studies have shown that 90% or more of the portfolio returns come from asset allocation, and researchers found that asset allocation have greater impact on reducing total risk than selecting the best investment vehicle in single asset category. And there are two categories in the asset allocation. One is strategic asset and second is tactical asset. And strategic asset identifies asset classes and proportions for those asset classes that could comprise the normal asset allocation. The strategic asset allocation is used to derive long-term asset allocation weights. And then we have the table for the allocation of the weights to different stocks. And we can say that generally the weights do not change over time. When the market value changes, the investors may have to adjust the portfolio annually. And tactical asset allocation produces temporary asset allocation weights that occur in response to temporarily changes in capital market conditions, and investors' goal and risk return performance are assumed to remain unchanged in this respect. And then we have conservative allocation. Conservative allocation, we have the three types of the allocation. One is conservative, which indicates low risk and low return. Then moderate type of allocation, which is associated with average return and average risk. And then aggressive is associated with high risk and high return. And we can also analyze this asset allocation with the help of Markowitz model that we did in chapter number 3, and there it was done in order to have the optimal allocation of assets in the portfolio for the individual investors, but here it is done for the institutional investors. And correlation between the asset classes is a key factor in building a optimal portfolio. According to Markowitz, investors, they are looking to have in their portfolio asset classes that are negatively correlated with each other. And using the not historical but future correlation coefficients between assets could influence the results remarkably, and we can take the historical data as well as future time period forecast in order to find out the relationship between the returns of the asset and to decide our portfolio items accordingly. And then we have the monitoring and revision of the portfolio that we can portfolio revision is the portfolio process of selling the certain issues in portfolio and purchasing new issues to replace them. That is main reason is that when the economy evolves, certain industries and companies, they become either less or more attractive as investments, and investors over the time they may change their investment objectives, and they in this way his or her portfolio is no longer optimal. And we have we can say that there are the different reasons that why the portfolio investor portfolio monitoring is possible. Changes in the market conditions, they are likely to induce the individual to revise their portfolio. Changes in investor circumstances are likely to induce the individual to revise the portfolio, and we have the asset mix in the portfolio. And we can say when the monitoring the changes in the investor circumstances, we must take into account the changes in the wealth, time horizon, liquidity requirement, taxes, and changes in legal environment and other needs of the individual in order to revise the portfolio and try to rebalance the portfolio. And there are different methods of rebalancing the portfolio are constant proportion portfolio, constant beta portfolio, and indexing. These are three important methods with the help of which individual can decide to readjust his portfolio. And basically the portfolio revision shows that individual should sell the assets whose prices are likely to go down, and should buy the should sell the assets whose prices are likely to go up, and should buy the assets whose prices are likely to go down. And that the revision of the portfolio is basically based on the argument that the individual investor or the institution should sell the assets whose prices are likely to increase and should buy the assets whose prices are likely to go down. And this was the today's lecture, and with this lecture we are going to end our course about the investment analysis and portfolio management. And I hope you will understand the concepts and ideas in the light of the discussion we made here, in the light of the details on the different topics, and with the help of the slides, and also the reading material will be able to help you. And over here we end this course, and good luck for your exams, for your future studies, and for your future. And take care of yourself, and take care of your studies, and keep up your studies with the help of this material. Allah Hafiz.